Hey everyone, good morning. My name is Isaac Tong. I am the lead manager of the Aberdeen Asian Income Fund. And I hope everybody has had a good summer off. So if you manage to visit Asia this time round, I think the one thing that you would notice is that change is a constant in Asia. Change is prevalent, it is everywhere around you, and people really embrace that change with a great sense of optimism. We embody that as well. So we really have this optimistic sense of Asia and the growth and change in Asia. And essentially what the income trust aims to do is to give you access to Asia's progress. So before we start talking about investments and how we position the trust, I think first and foremost, what does the trust give you as investors, as shareholders? So first and foremost, the trust gives you a very strong track record. We have delivered over 4%, around 4% excess returns over and above the benchmark over the last 5 years per annum. So first thing you get is a strong track record. The second thing is an attractive dividend yield. The trust is now yielding just north of 7%, and we think that is a very attractive and healthy and sustainable level of dividend yield. And why I say sustainable? Well, the board of directors does agree with that, and we have instituted a dividend, an enhanced dividend of 6.25% of NAV per year paid out to you quarterly. To that extent, we have had 16 consecutive years of dividend increases. As such, we have achieved AIC's next generation dividend hero status, and we are quite intent on furthering and continuing that good track record. The next thing you should note is that the trust comes to you cheap. We are currently trading at a 9% discount to NAV. And if you compare that to our closest peers in the category, we trade at over a two times discount compared to closest peers. And rest assured, the board of directors is very aware of this and is really focused on doing its utmost to manage that discount. So that's a bit about the trust. And really today, on the back of that, I would like to leave you with 4 key takeaways. And that is why Asia, why income, why Aberdeen, and why now, right? Why is now a good time to be invested in Asia? And after we go through those 4 key takeaways, we can talk a little bit about performance as well as how we position the trust going forward. So with no further ado, why Asia? Well, Asia to us is the heart of global growth, right? If you look at the long history, Asia has and will continue to drive over half of global GDP growth. So think about it. Asia's growth is driven by just a catch up in terms of technology and best practices with developed markets. There's high savings rate in Asia. A lot of Asian countries still enjoy that demographic dividend. And really all these things propel the strong growth outlook in Asia. So like I said, change is all around you in Asia. And that change will bring about very dynamic growth. So the thing that is less spoken about though, is that this strong economic growth in Asia has really translated over the last 20 years to strong total shareholder returns, right? So there has been a very nice transmission mechanism between economic growth and growth in corporate earnings, which tends to translate over the long run to shareholder returns in terms of stock price performance. And, I think this is an underappreciated fact that transmission mechanism does not always happen this way. And in Asia, I'm happy to say that it has happened over the last 20 years. And the trouble is, over the last 5 to 7 years, due to the rise of US exceptionalism, you have the Magnificent Seven companies, which are winning in their own right, has really taken that spotlight away from this growth story in Asia. And I think that, with the current state of affairs globally, there is a good case for that spotlight to shine back on Asia's growth story, which has always been the case. It's just been slightly forgotten over the last 5 to 7 years. Another thing that Asia has going for it is it really offers that unique blend of dynamic growth via the emerging Asian economies, as well as dependable income via the more developed Asian economies, right? So we have on the right hand side of that chart, we have really natural income markets, right? So markets like Indonesia, Taiwan, and Thailand, where companies have really struck a good balance between paying out dividends and growing earnings, right? So these are very natural income markets for us. And then you have another segment of Asia, which is cyclical income markets, such as China, India, and South Korea, right? So these markets are still striking that balance between current income and future growth, but they do offer us, because some of these markets, such as China and India, are very broad and deep, they offer us a lot of opportunities in income as well, but really add either value or growth to the overall portfolio. And then you have consistent income market, so very dependable, defensive stream of earnings and income. And these tend to lie in the more developed side of the Asian markets, which includes Australia, Singapore, and Hong Kong. And I think some of you here today might, also look at emerging markets as an asset class. And I think the key difference is really these consistent income markets, right, which offer you very dependable, very reliable income, right, compared to other emerging markets, which are more on the growthy end. And if you look at other emerging markets as well, bottom left table, you would see that GDP growth, that's real GDP, is actually not very high. In fact, a lot of growth in ex-Asian emerging markets coming from inflation, right? So just a very different proposition there, but I'll argue that Asia really has, a couple of levers to pull that is absent in emerging markets outside of Asia. So that's really why our proposition for Asia, Asia is a growth market, right? And so that brings us to why income, and perhaps the more important bit of today's presentation. So we think that Asia's strong growth potential comes also with a wider range of outcomes. And Asia's growth should really be harnessed through a balanced approach, which to us is a quality income approach to investing. So we'd like to give an example of driving a car down a highway. So imagine you're sitting in a car and you're driving down a highway, and the thing is, unlike the highways in the UK, this highway that you're driving on is very windy, right? A lot of curves in the road. And the problem is your car is an Asian car and can only go fast. So you really want to navigate this challenging winding road with a fast car. And really one of the better ways to do that is to be sure to have a good functioning set of brakes, good airbags, good navigation systems. So, to get you from your starting point to your ending point, which is your investment journey in Asia, what you really want to do is to really navigate those unforeseen outcomes. And to us, we're essentially trying to do this for you in the trust by investing in high quality dividend franchises. So the good news is the market already understands this. So if you look at the sources of returns in Asia Pacific over a very long period of time, you'll see that half of total returns have been driven by dividends. And so we think that the market is agreeing with this fact that growth comes with a larger range of outcomes, and it's demanding more certain income today to compensate you for that large range of outcomes, right? And we think that this will continue to be the case. So why dividend? The case for dividends is it really narrows in that range of outcomes, and it really prevents company management. It steers company management away from making bad capital allocation decisions. So there are many ways to destroy capital out there, but we think of three classic ways. The first one is M&A. So M&A tends to sound very good on paper, but it tends to fail globally, not just in Asia. It's quite a high failure rate, actually. And then the second way that management tends to destroy value is excessive cash hoarding, right? Running lazy balance sheets. And the third way is growth for the sake of growth, essentially empire building without concern of returns, right? These methods tend to lead to poor outcomes. And essentially what a strong dividend policy does is it takes away capital from management every single year. And with less capital on hand, management would think 2 times, 3 times before making those capital allocations decisions that tend to destroy value, right? So it is a form of corporate governance to us. Now, we talked about investing in high quality dividend franchises. What do we mean by this? It all sounds very nice, but in practice, it is slightly more challenging, right? When we look for stocks, we are bottom-up stock pickers, and we really have 3 guiding principles when investing for this trust. The first principle we have is we want to be invested in high quality businesses. So by this, I mean businesses with very strong moats, very good management, very high corporate skill. And that usually results in high returns on equity, ROEs, over and above their cost of equity, right, through the cycle over the long term. And the second principle that we have is we want these businesses to have strong, reliable cash flows, especially free cash flows. And our third principle would be we follow these free cash flows towards very sound and strong dividend policy. So these 3 factors are not mutually exclusive. In fact, they are all intertwined with each other. And the net outcome of that is a high quality dividend franchise that we want to back over the long run. So after identifying these types of companies and businesses, what we want to do is to invest across a range of dividend yields to really optimize the total returns profile for the trust. So let me give you a couple of examples here. I think we are agnostic between companies at earlier stages of their corporate life cycles and more mature stages. We want to back high quality businesses, right? So on one hand, we are invested in a company called Tencent, which is an internet platform in China, right? If you have visited China recently, you would have had to download their app called Weixin or WeChat, right? It's hard to navigate China, as a tourist or as someone who lives there without this app. And we think Tencent is going to be quite a fast-growing franchise, right? We think it can compound earnings in the low teens over the next 5 years, every single year. The thing is, Tencent's dividend yield is about 1%, right? So you have low teens growth and 1% cash yield. And then on the other hand, we have DBS Bank. It is one of the highest quality banks in Singapore. But because it's based in Singapore, which is a more mature market, DBS will compound earnings at a slower rate, right? So we expect DBS to compound earnings maybe 3-4% per year over the next 5 years. But the thing is, its cash dividend yield is 6%, right? So if you add up the dividend yield and the growth, and assuming you invest in both at reasonable valuations, the total return profile starts to look quite similar. And we think that both companies are high quality, so we can really be invested in both types of companies at the same time for the trust. So what's the net outcome of this? The net outcome of this is the trust has 2 very distinct styles. The first is quality. And once again, I mentioned we measure quality in terms of ROEs. So you see that ROEs are superior to that of the benchmark. And then the second style is income, which we measure through dividend yield. And you could also see that our dividend yield is exceeding that of the benchmark. And we anticipate that these 2 styles will remain consistent over the next couple of years for the indefinite future, in fact. And this is the consistent style that we have had for this trust. So having said all that, why Aberdeen? Well, Aberdeen, quality is a North Star at Aberdeen. It influences everything we do, from the research process to how we construct portfolios. So having this platform, this quality-focused platform, is a very natural home for what we want to do in this trust, which is a quality income-focused trust. It's a perfect platform for us to run this trust. And the investment managers are myself and Eric Chan. We're both based in Singapore, and we have 26 years of investment experience between us in Asia, and we are further supported by 40 investment professionals also sitting on the ground in Asia. And I cannot emphasize the importance of this. You would see the vast majority of our investors are sitting out of Singapore, where Eric and myself are based as well, and just really sitting in the same country, meeting the same companies, and doing research together really enables a lot of synergies between the investors in terms of idea generation and so on and so forth. It's really an understated advantage that we have. Of course, to us, meeting companies is paramount. We want to understand the companies we invest in. We want to meet the management responsible for making decisions at those companies. As such, we have conducted over 1,000 investment meetings over the last year, and we continue this pace. We also vote proxies very frequently, and this is really to give you a voice at shareholder AGMs. So why now? Why is now a good time to invest in Asia? Well, we think that Asia is undervalued and underestimated. So what do I mean by that? Well, if you look at the standard classic PE valuation metrics, you would see that on the chart on the left, you would see that Asia is undervalued compared to that of developed markets, right? In fact, if you look at the PE spreads between Asia, which is in the black line, and that of the world, that spread has been the widest it has ever been since 2006, right? So Asia is cheap. And then on the slide on the right, you'll see that in terms of earnings power, which is returns on equity, Asia is just about, that black line is just about rising above pre-COVID levels. So Asia is just getting back to where we started, right? And we are poised to grow off that base. Meanwhile, if you look at developed markets in the orange line, you'll see that they're marking all-time highs, right? And a lot of this is driven by the Magnificent Seven companies in the US. While they are excellent in their own right, I think the message here is that excellence is getting priced in quite aggressively, and they have a high bar to hit in terms of earnings power because they're already doing so well, right? So I think Asia is very well set up there. Another reason for Asia is that policy tailwinds are really building in a few countries. So let's start with China. So China is currently unwinding 4 years of very restrictive policy, and that really started in late 2021 in the name of common prosperity. So today, if you go to China, common prosperity is not quite spoken about anymore, right? In fact, the emphasis is on investability in the markets, boosting certain strategic sectors, and really lifting up the Chinese markets, right? So we are 4 years into that, and today policy is much more accommodative. If you look at South Korea, they have this thing called the Value Up initiative, which is essentially a corporate governance, capital allocation rejuvenation, right? So Korea has always traded at a discount compared to its peers. The government's quite aware of that, and it's seeking to really narrow that discount by strongly encouraging companies to strike a balance between capital allocation, especially dividends, and growth, right? So a lot of companies have already come out with dividend targets. So the banks, for example, the three large Korean banks used to have a payout ratio of about 25% 3 years ago. Today, that is close to 45%. And next year, 2026, they're all targeting 50% and above. So we are already, apart from the positive news flow, the news headlines, on the ground, we are seeing improvements operationally. and that really makes us quite positive. Last but not least, we have Asian tech names, right? So we're talking about Taiwanese tech names, as well as South Korean semiconductor names. And really, Asian semiconductor companies are, really the heart of the whole AI trend that we're seeing right now. In fact, Asian semiconductor companies provide the picks and shovels for which global AI infrastructure is built off on. And if you look at the companies we cover at Aberdeen, you'll see that the vast majority of these companies derive substantial amount of revenue from AI and demand, right? So they're in fact AI plays. However, on the chart on the right, you'll see that these companies are trading at, again, a discount compared to their global peers. So once again, they are excellent companies and enable the AI trend that we're seeing right now, but they are once again underappreciated. So that really wraps up the first part of my presentation. And if you have already forgotten everything that I just said, well, just remember these four things. The first thing is Asia is the heart of global growth. However, this growth comes about with a wider range of outcomes. So it is essential to consider a quality income approach. And Aberdeen is a quality focused investment house, and it's really the perfect platform for us to run the strategy on. And Asia, and it's a really good time for Asia right now because we are undervalued and underappreciated.
Isaac, thanks so much indeed. Really fascinating tour of what's happening in Asia at the moment for the investor. I've got some questions coming in, which I'd like to pick up with if we can. What benchmark are you measuring against? That was one of the questions that's come in. You were talking about benchmarking and you were beating benchmarks on a number of different metrics. Which benchmark are you referencing?
Right, that's a good question, and it brings me to performance, right? So our benchmark is the MSCI Asia Pacific ex Japan benchmark. So that includes Australia as well. And you could see performance has been strong over the long run, especially. So we are ahead of the benchmark on that slide on a 1, 3, and 5 year basis. Of course, we are long term, so please do focus on that 5 year number. We are confident that we can sustain this performance because of our very consistent quality income approach.
Just picking up on a couple of other points before we leave you, what's your view on the low valuation of Chinese stocks? How much the portfolio is invested in China at the moment? Clearly, you're looking at the Asian picture globally. You've got some other big, strong economies, such as Korea, which doubtless drives a lot of growth. But what about China particularly?
Yeah, that's a good question. So here are country weights. These are active weights, so overweight and underweight. And you could see that, China, we're currently running an underweight position. You should combine that with Hong Kong. But if you add Hong Kong into that bar chart, we're still running an underweight position. Chinese valuations are kind of middling right now as we speak. So they are not they're not very cheap, but they're not expensive either. Right. But if you look at a lot of Chinese earnings, we think that the market has gotten ahead of itself slightly. So we're running a slight underweight position.
And in fact, I think at the beginning of the presentation, you mentioned the fact you were trading at a 9% discount. My question was at that point, I was going to say, well, why is that? I guess that's part of the reason. Can you explain that 9% discount?
Yeah. So, historically, our discount has been slightly above that, right? So 9 is trending nicely. So we started the year with a discount of about 11-12%. So that discount has already gotten pulled in a little bit. The reason for that is twofold. We think, right? Can never be exactly sure. But I think first, Asia has done well year to date, right? Asia is up almost 26-27% in US dollar terms, right? Compared to mid-teens in the US. So interest in Asia is coming back. So that could help the discount. I think secondly, we have announced that enhanced dividend policy of 6.25% of NAV, right? That takes you to about a 7% handle when it comes to, the actual dividend yield you're getting on the trust. And I think, shareholders appreciate that, right? And it is a fixed commitment as well, 6.25%. So I think those two factors, along with proactive share buybacks by the board of directors, could have helped narrow in that discount. And we hope there is more to come.
Yeah. Look, I talk to a lot of investors, and every single event I go to, I speak to people, AI always comes up. You mentioned it. We've got to talk about it. How you position the portfolio for future growth in this area? What has it at the moment got a little bit ahead of itself, do you think, and you're pedaling back a little bit? What's your view on the longer term picture? The question was, how are you positioning the portfolio for growth in AI? But I mean, this is a massive area that we're all coming to grips with, and how it's going to affect our lives and how we're going to monetize it as well. But where is the keen investment going around this area?
Right. So if you look at, once again, that chart I put up, the right-hand side, you'll see information technology, right? So a lot of the AI sort of tech hardware investments go into that bucket, right? So you could see we are overweight that sector. But I think one thing to note is AI, there's a constant debate about AI, right? Even internally here at Aberdeen. And I think that debate's very healthy, because AI is really perhaps 2.5 years in the making. It's quite a new phenomenon. And, companies globally are just really backing this trend, right? In terms of investing CapEx behind AI. So I think the question here is, what's the return on investment of AI? And we are seeing positive signs of that in terms of monetization, but I think that the jury's still out there. So we want to invest cautiously behind this thematic, and not, because it could grow. This theme could continue for 1-2 years, but beyond that, I think it gets a little bit more hazy in terms of that outlook. But overall, personally, I'm quite positive on AI. I'm also a user of AI. I'm part of the monetization drive. So personally, I'm quite confident on this technology. It's just the question is, have we gone a little bit too quick on that, right? So we don't want to overpay for these excellent AI names that we have in the portfolio. That overweight.
Absolutely, that is key. I think is the fact of getting them at the wrong moment. Just very briefly, keeping that page up. I don't see Vietnam there. What's your exposure to Vietnam? I asked this question. In fact, I'll go into this more detail with at 11:30 with Craig Martin. But I think I've got to talk about this. It was a question that came up. Do you have investments in Vietnam, or are you waiting till it gets reclassified as an emerging market? Now, this was covered in an article on Reuters I read the other day about the FTSE Russell Index expected to upgrade Vietnam to secondary emerging market status, I think, from frontier market. First of all, are you invested there? If so, to what degree? And does this give you some encouragement to go there?
Yes. So currently, we don't hold anything in Vietnam. Many moons ago, I used to be a Vietnam fund manager. So personally, I'm quite positive on Vietnam. But then why don't we have Vietnam for this strategy, right? And it comes back to dividend policy, right? We want to strike that balance between growth and income, right? To harness Asia's growth potential, right? And the problem with Vietnam is dividend policy there is still emerging. So it has a lot of growth potential, a lot of good emerging companies coming out of Vietnam, but they don't really have that strong dividend policy that we're looking for. This will come. I'm confident this will come over time, but corporates have to reach that stage before we can really hit that balance and invest in Vietnamese companies for the trust. But we're on the lookout.
Yeah, look, Isaac, we'll have to leave it there, but thank you so much indeed for joining us. It's been an absolute pleasure catching up with you from Aberdeen there. That's Isaac Thong. He's Senior Investment Director at Aberdeen Asian Income Fund Limited, with his views on the Asia market and as things stand there at the moment. So, Isaac, thank you.